Hi there and welcome to Investment Ninja, maximizing returns and minimizing risks with your host, Eden. Are you ready to embark on a journey into the world of smart investing? Join Eden as we dive deep into strategies, tips, and insights that will transform you into a financial ninja. So, grab your notepads, subscribe to our channel, and get ready to level up your investment game with Eden, right here on Investment Ninja. 1. Educate yourself. Before diving into investments, it's imperative to establish a strong foundation of financial knowledge. This entails comprehending the intricacies of financial markets, the diverse asset classes available, such as stocks, bonds, and real estate, and various investment strategies. Gaining this essential knowledge is best accomplished through courses and books on investing and finance. These resources equip individuals with the skills needed to make informed investment decisions, assess risk, and identify opportunities. By investing time and education upfront, one can navigate the complex world of investments with greater confidence, reduce the likelihood of costly mistakes, and work towards optimizing their financial future. 2. Asset protection. To safeguard your wealth from unexpected events and legal issues, it's essential to implement asset protection strategies like liability insurance and estate planning. Liability insurance shields your assets by covering legal expenses and damages in case you are sued or found liable for accidents, ensuring that your personal wealth remains intact. Estate planning, on the other hand, enables you to control the distribution of your assets, reducing the risk of disputes and potential losses due to mismanagement. It includes tools like wills, trusts, and powers of attorney, helping you maintain control over your assets even in times of incapacity or upon passing. These measures not only shield your wealth, but also provide peace of mind, ensuring that your hard-earned assets are preserved for your intended beneficiaries and protected from unforeseen financial threats. 3. Diversify your portfolio. Diversification is a crucial risk management strategy in investing. By not concentrating all your investments in a single asset or sector, you spread your money across various asset classes and industries. This approach minimizes the potential impact of a poorly performing investment on your overall portfolio. Essentially, it's about not putting all your eggs in one basket. Different asset classes, such as stocks, bonds, real estate, and commodities, tend to react differently to economic conditions and market fluctuations. When some investments underperform, others may thrive, helping to balance out losses. Diversification doesn't eliminate risk entirely, but it does reduce the risk associated with individual holdings. A well-diversified portfolio aims to achieve a more stable and consistent return over the long term, making it a fundamental strategy for prudent investors. 4. Asset allocation. The ideal portfolio composition should be tailored to your risk tolerance and financial objectives. Generally, younger investors with longer investment horizons can embrace higher risk and allocate a significant portion of their portfolio to stocks. This strategy capitalizes on potential long-term growth, even though it exposes them to market volatility. Conversely, older investors nearing retirement often favor a more conservative approach, with a greater allocation towards bonds and stable investments. This choice prioritizes capital preservation and dependable income streams. Striking a balance that suits your individual financial circumstances and goals is pivotal, ensuring that you can harness growth opportunities while also securing your financial future. Ultimately, asset allocation should be a personalized strategy, reflecting your unique risk tolerance and aspirations to construct a well-diversified and resilient portfolio. 5. Risk management. To navigate investments effectively, grasp and mitigate risk. Use tools like stop-loss orders to limit losses at predetermined prices. Set risk limits to maintain discipline and protect your capital. Be cautious, avoiding overly promising investments prone to fraud. Never invest beyond your means, safeguarding against financial ruin and emotional distress. These practices enable informed decisions and financial security in the investing world. 6. Long-term perspective. The stock market's short-term volatility is a well-documented phenomenon, characterized by fluctuations driven by various factors like economic news, geopolitical events, and investor sentiment. However, Historical data consistently shows that over the long term, the stock market generally exhibits an upward trend. Consequently, it's essential for investors to resist the temptation to make impulsive decisions in reaction to these short-term fluctuations. Attempting to time the market or reacting emotionally to daily or weekly market movements can often lead to missed opportunities and even losses. Instead, a prudent strategy is to stay invested for the long haul, taking advantage of the power of compounding and the market's tendency to reward patient investors. By maintaining a well-diversified portfolio aligned with your financial goals and risk tolerance, you can better weather short-term storms and position yourself for the potential growth and wealth accumulation that the stock market has historically offered over extended periods. 7. Cost control. To optimize your investment returns, it's crucial to minimize fees and expenses associated with your portfolio. High fees, whether in the form of management fees, trading costs, or other expenses, can significantly erode your overall gains over time. One cost-effective strategy is to consider low-cost index funds or exchange-traded funds, ETFs, as they offer diversified exposure to the market at a fraction of the cost of actively managed funds. These passive investment vehicles typically have lower expense ratios, translating into more of your investment capital working for you rather than being siphoned off in fees. By consistently opting for cost-efficient investment options, you can harness the power of compounding, ensuring that a more substantial portion of your returns remains in your pocket, ultimately boosting the long-term growth potential of your portfolio. 8. Regular monitoring and rebalancing. Regularly reviewing your investment portfolio is a crucial practice to ensure it remains in harmony with your financial objectives and risk tolerance. Over time, market fluctuations and changes in your personal circumstances may cause your asset allocation to deviate from its intended balance. To counteract this, periodic portfolio assessments are essential. If you find that your portfolio's allocation has shifted, it's vital to rebalance it by adjusting the holdings in accordance with your original plan. By doing so, you realign your investments with your risk tolerance and goals, reducing the potential for overexposure to risk or missed opportunities for growth. This ongoing monitoring and rebalancing process can help you maintain a well-structured and diversified portfolio that is better equipped to weather market turbulence while striving to achieve your long-term financial objectives. 9. Tax efficiency. It's essential to consider the tax implications of your investments. Utilizing tax-advantaged accounts such as IRAs and 401(k) can help minimize your tax liability and enhance your long-term returns. Contributions to these accounts often come with tax benefits, like tax deductions or tax-free growth, depending on the account type. Additionally, tax-efficient investing within taxable accounts, like capital gains tax optimization and holding investments for the long term, can further boost your after-tax returns. Being mindful of taxes and strategically using tax-advantaged vehicles can ultimately preserve more of your wealth, allowing it to compound more effectively over time and aligning your investments with your overall financial goals. 10. Avoid emotional decisions. Emotions can significantly impact investment decisions, often leading to impulsive actions that harm long-term returns. Fear can prompt investors to sell during market downturns, locking in losses, while greed may push them to chase hot trends without proper research. To mitigate these emotional pitfalls, it's crucial to adhere to a well-thought-out investment strategy and avoid making hasty, emotion-driven choices. Sticking to your predetermined plan, based on your financial goals and risk tolerance, helps ensure discipline and consistency in your investment approach, reducing the detrimental influence of emotions. By maintaining a steady course, you're more likely to make rational, informed decisions that align with your financial objectives and yield better long-term results. And there you have it, fellow investors, the key principles to become an investment ninja. We hope you gained valuable insights on optimizing returns and minimizing risks. Remember, success in the world of finance requires continuous learning and adaptability. Keep honing your skills, stay vigilant, and you'll master the art of investment. Thanks for tuning in, and may your investments always be prosperous and secure.